Okay, good morning, everyone. I think today is the last day in March 2025. Today is 31st March 2025. And we'll continue from where we stopped, but much more, we might try to lay one or two foundations again to remind ourselves where we started from. Okay, to do that, first, the first few minutes, I'm going to share a video resource for you to have a more or less a reintroduction of what we've discussed so far, so that at the junction where we'll be wrapping up on financial instruments, you'll be able to catch up where necessary. Okay, thank you. Okay, to refresh our memory, who is raising up hand? I can't see. Okay, I think I can see one hand. Okay, can unmute. Adeyemi.
Okay, sir. Thank you, sir. Question 1. Atna PLC acquired a deep discount instrument of the face value of 10 million naira for 9.1 million naira. Okay. The investment horizon for the instrument is 3 years. Required. Determine the effective interest rate of the instrument. A. B. Construct the amortization schedule for amortized cost measurement. C. Show the relevant account entries for the respective years.
Thank you very much. Okay, now I can switch it to my Excel. Okay, I've copied the question, and let me switch it to my Excel. Okay, that is it. Okay, I've switched it to my Excel. I believe we can see the question. Okay, let me extract the information one by one. We have the face value of the bond. We have the future value. And remember, the face value is simply as a purchase price here, which synonymous to the fair value at the point of acquisition. Initial recognition. Okay. Now we have 10 million. Sorry, that's 9.1 million. Okay, I have to disable annotation because some people are writing on my screen. I've done that now. Let me try and unshare and share again to take up the stuff put on my screen. Okay. And the future value is 10 million. All figures are in error. Let me do that. And what is the duration? The duration or tenor in this case is 3 years. Okay. Now, what we'll only be doing here is what is the effective interest rate. And we can do it in different ways because this is a single cash flow. No intermittent cash flows. Therefore, I can simply use a simple PV function or rate function. Therefore, using the following functions, let me put Excel functions. I believe you can see the screen well. I can enlarge it. Okay. Therefore, I can put up rate. Rate is a function. I can open the function. And what do I need to do? Is to put the number or period. You can read what it is. And what's the number? It's 3 years. Okay, you look at the payments. There's no payment because there's no intermittent cash flows. What's my PV today? I'm investing 9 million, and probably that's a negative cash flow, and I'm realizing 10 million after 3 years. And the type is such that we assume that interest accrue at the end. That is type 0. Otherwise, if interest accrue at the beginning, like annuity due as I've explained earlier in class, it will be 1. Therefore, in this case, what rate does it give us? It gave us exactly what we got in class. Okay, if you can remember what we got in class. Okay, and if you want to more or less summarize it to just 2 decimal places, I'll say this is my effective interest rate. Okay, you can also get it in different ways. Alternative way is to construct a line chart or a timeline. In this case, I have year 0, year 1, year 2, year 3. Okay, in that, I have my descriptions of cash flows. I have my cash flows. Let me say I have my discount factor. And I have my present value. Okay, in this case, I'll say this is my purchase price of the bond. This is my coupon, which there was none. Coupon. But in year 3 is going to be coupon plus my realization value or redemption value, as the case may be. Therefore, what is my investments? I had an outflow when I invested 9.1 million. I'll get nothing because they are 0 coupon bonds. But at the final day, even though I'm getting 0 coupon, but I'm going to get back the face value, which is 10 million. Sorry, this is not the face value. I messed that up. The future value is simply as a face value. Okay. Now I'm going to add my 0 plus my face value or my future value, which is that. Now I need the effective interest rate. I can use GoSeek as a function. In that case, I don't know what my rate is. I can guess any rate. If I like, I can put 0%. Okay, what then do? I calculate my discount factor, 1 plus R. Now I'll put my R to 0%. I can leave it blank itself. And 0%, I lock that. Okay, then what's wrong with my function? Okay, it's working now. I've locked it, raised to power minus n. What is my n now? N is 0 in the first period. Now, I can lock it down. You see that everything is 0, is 1, all because I put 0 as my rate. If I put 1% as my rate, it starts to change. If I put 10% as my rate, it starts to change. All because I put the formula. And you can see the formula here. It is 1 plus R, 10% raised to power minus 1. If I do it here, it's the same thing. Okay, now I can take it back to 0 and I can still leave it at anything. Now, what's my present value? My present value is the product of my cash flow and the discount factor. I can run it down. Okay. Now, the question then is, if I sum my present value of outflow and inflow, what do I get? I'm getting 900. This 900 represents the return I'll have earned over a 3-year period. Okay, but what I wanted is what rate is it that if I apply it on this discount rate, it's going to make the present value of this initial outflow to equal the present value of this inflow, so that the net position will be 0. And therefore, what do I do in that case? I do a go seek. And therefore, I look for my data points. Under that, you have what if analysis. And in what if analysis, I'll click go seek. Under that, what do I do? Now, what am I seeking? I'm seeking a situation where this value here, which is C, this is the value, H15. I'm seeking a situation where H15 will become 0. Now, what value am I seeking? Is 0. And what will influence it to be 0 is this effective interest rate, which I've initially put at 0 or put at any rate. Now, I want it to run an iteration and it will give me an answer. Now, what answer did it give me? Let us check in decimal points. It's giving me the same thing. Okay, which means this is another way we can do that. Okay, and that is that. Now, there are other ways you could do by using IRR or XIR. The difference between the two is that IRR does not take exact date into cognizance. It only takes exact intervals. But XIR takes exact date into consideration. Now there's no dates here, we only have intervals. And therefore, I can use IRR as a function. I call up the function. Okay, what do I need? I need the values. What are the values? These are the values I have. And you want me to get a rate. I might decide not to get a rate. I'll just leave it blank. And it will give me the rate. And it's also giving me the same thing. Which means using different functions in my spreadsheet, I can determine that without any thinking required. It doesn't take 1 minute to determine effective interest rates using spreadsheets. I believe this makes sense. And if there's a question now, we can ask that question before I proceed on other ones we've done in class. Okay. Any question, you can show up your hand and you can send me a chat. Okay. If not, I believe this is very straightforward to understand. Okay. There's no question. Okay. Let me now move to the next one we've done in class. Those ones, especially I said, it's not practicable in an exam for you to find the ER. The examiner will provide it. But if you are using spreadsheet, the examiner need not provide. And let us pick it one by one. Now let's look at question 2. Who will read question 2? A volunteer? A volunteer. Okay, over to you, Daniel. Or sorry, Daniele.
Okay.
You can read? Yeah.
Sanogo PLC borrowed the sum of 1 million naira from Zoe Bank on 1st January 2016 with a maturity date of 31 December 2019. The associated fee was 2% flat amount on the borrowed fund. The interest rate for the loan, as agreed with the lender, is 18% per annum. The effective interest rate for the loan is 19.047%. The loan repayment is to be repaid yearly, both the principal and interest components based on an annuity like payment like. Required: A, construct the amortization schedule for amortized cost measurement. B, show the relevant account entries for the respective years.
Thank you. Okay. I've copied it again. Loan amounts. Loan amount here is 1 million. Transaction cost is 2% flat. Flat. Interest rates is 18% per annum on flat. Okay. What else? Okay. Effective interest rate is what we are looking for. Okay. Now, annuity payments, which are the equal payments. We don't know what it is. Okay, we're going to determine that first. And remember, we said recall present value of ordinary annuity. Okay, how do you determine present value of ordinary annuity? We are going to use the PV function. PV function in Excel. Now, if you look at PV function, let me just show you. I can call it up. Now, what is that? I can find my payment function. Now, let's look at the payment function. I didn't show you the PV function. So let me show you the PV function. This is the PV function, which means if you want to look for present value, you have the rate, the number, the payment, the future, and the time. Is it annuity due or annuity present? 1 and 0. But let me look at the payment function because we are looking for annuity payment. Therefore, I'll use PMT. I can call up the function, which means I need rates. What is my rate? My rate is 18% per annum. Number of periods. Okay, I've not included number of periods. Let me put that. Okay, number of periods. Duration of tenure. Years. How many years is this? You can calculate it. Now, another way you can calculate it is this. Let me show you. Start date. Start date is 1st of January 2016. And end date is 31st of December 2019. Okay, and I'll tell you that this date, 31st of December 2019, is the same thing as 1st of January 2020. And you'll see why I'm saying that now. Now, what I can do is the difference in the tenor, I can determine it directly. Now, if you use your hand to count, that is the entire 2016, entire 2017, entire 2018, and entire 2019. That's 4 years. But what will I do here? I'll just put the function. And this function, what do I need there? I need the difference between these two dates. The first date, the second date, and I'm looking for difference in years. I'll use y as a function. And it gave me 3 years. Why? Because it's giving me 3 years plus, because it's looking at this exact date. Now, if you look at this exact date, it does not cross from 1st of January to another 1st of January, which is exactly 365 days. Therefore, what do I do is that rather than use 31st December 2019, I can use that 31st 2019 and add 1, or I use 1st of January. If I use 31st and add 1, sorry, is equals to, and I had 1. Sorry, what? Okay, don't worry. Let me just use 1st of January 2020. It will give me exact 4 years. Okay, that's just what I'm trying to show you. Okay, now what then do we need to do is to now use this payment function I started with. I call it up. I need the rate, which is 18% per annum, the number of periods, which is 4 years. PV. The PV is the amount of loan I took. My future value is that at the end of the day, if I'm to pay equal amount, which constitute interest and principal, after 4 years, the future value will be 0, which means I will have fully paid the loan. And the type of the loan is where I pay interest at the end, not at the beginning. At the end is ordinary annuity, at the beginning is annuity due. At the end of the day, I have this. This is what I'll be paying. And if you check what we did in class, this is what we got. Okay, now, but that's not what we are looking for. The real crop of the matter is we needed to determine effective what? Interest rate. But in this case, there is intermittent cash flow, or there are intermittent cash flow in this case. Unlike in the first one, let me put in it, no intermittent cash flows. But in this one, there are intermittent cash flows. Okay, therefore, what do? I can call all of those functions again. Okay, let me use rate function again. Okay, let me call up rate function. What's the number of tenor? 4 years. Payment, I now have the payment. I can link it directly. What is my PV? Is the loan amount. What my future value is 0, if you remember. And what is my type? It is 0. Now, my PV here, if you remember, based on IFRS, because I'm measuring them at amortized cost, therefore my PV will be my fair value at initial recognition less my transaction cost. Now, in this case, what is my transaction cost here? It's 2%. Therefore, it means 1 million is what I borrow, but I have to pay 2% flat as a processing fee to be able to get 1 million, which means net what I get is 1 million minus 2%. 2% of what? 2% of the 1 million, which means net, like what we got in class, I'm getting 980,000. I can see it shown here clearly. Okay, 980,000. At the end of the day, what is my effective interest rate? You can see it as 19.046, which is what we have here as 19.047 by rounding. This will give me the exact amount, as you can see it here. Okay. Now, the same thing I can do go seek. If I'm to do go seek, I come back to my table. I can copy this table and develop on that table. Okay, now in this case, my purchase price is not purchase down, my loan amount net of fee. What is my loan amount net of fee? Is 980. How do I get 980? I borrowed 1 million, but I suffered 2% charges on that 1 million. Therefore, what I receive net is 980. What is the coupon or interest in this case? Let me use the word interest here. This loan. My interest here interest and principal. Yeah. Interest and plus portion of principal. I'll pay it, which is my annuity amount. Okay. Now, how much am I paying every year for the next 4 years? Okay. This is the amount I'm paying. Every year for the next 4 years. Now, let me assume again that my stuff is blank. I'll just use it blank now. I'll leave it blank. Therefore, now, at the end of the day, what can you see here? You can see that at the end of the day, I've paid 135,000 more. The question then is, what rate will equate the present value of this inflow to the present value of this outflow to make this 0? Therefore, what do? I go back to my data point, my data tab. I go to what if analysis, and I say go seek. Now, what go am I seeking? Is this cell? I can see how it's been highlighted. I want to seek such that the value is 0. And what variable will make it 0 is the influence of my effective interest rate. And what is that? It will give me differences. No? Is that function wrong? What rate did I use? Okay. Yeah. Okay, yeah, I saw the error. The error is I didn't sum up the fourth line. I have to sum up the fourth line. Now, what I got earlier was wrong because I didn't sum up the 4 lines. Now it is 286. Now, but this 286, let me go back to where it was blank. It's supposed to be 506. Now, this 506, I'm seeking it to become a 0. Therefore, what do? I make it 0, and I influence it with my go seek rate, EIR. And at the end of the day, it's able to give me 0, and it gave me the same rate. Okay, that is that. Now, I can also use IRR. And if I'm using IRR, what I just need is to call up the function IRR. And what then do? I pick from year 0 to the last year, the cash flows. I don't need to guess, and it gives me the same thing. And that's how you determine effective what? Interest rate in that regard. If there's any question on this, otherwise we can move to the third one. So that at least we satisfy all righteousness in building effective interest rate. Very simple as ABC. Okay. If not, can somebody read question 3? Who will volunteer? I need a volunteer. Okay. I can't see any hand up. Okay, I think I can see one hand. Let me see. Over to you.
Ramsey plc borrowed the sum of 1 million from Zoe Bank on 1st January 2016 with a maturity date of 31st December 2019. The associated fee was 2% flat amount on the borrowed fund. The interest rate for the loan agreed with the lender is 18% per annum. The effective interest rate for the loan is 18.754%. The term of the loan is such that interest are financed yearly, while the principal sum is paid as a lump sum. Bullet valued in bracket. Payment at the maturity of the loan. Required. Construct the amortization schedule for amortized cost measurement. Then B, show the relevant account entries for the respective years.
Okay, thank you. Okay, let me go back to my spreadsheet. Okay, I've copied the question. Let me just copy the template and Minute off. Now the information here is 1 million. This is still flat rate 2%. This is the same thing. All of these are the same. The only difference is that payment, payment is balloon. Okay. Or bullet. Why is interest? It's financed yearly. Okay. Therefore, in this case, what then do we do? Therefore, this is not relevant. This function is not relevant. Okay. Therefore, what is relevant now is this is interest alone. Why this is interest and full principal repayment. Okay. Therefore, again, what is the loan we took? 1 million minus 2% of the 1 million, which is our transaction cost. And that gives us 980. Now, interest only, remember, is 18%. $18 per annum times the loan amount give us 180. We'll pay 180 each year for the next 4 years. But in the last year also, in addition to that 180, we'll pay back our principal amount, which is 1 million. Therefore, remember, because we are paying, I'll put all those figures in negative. Okay, which means net, the total finance cost is 740. Okay, now let us determine the discount factor. Now, we don't know the discount factor. We'll leave it blank because that's what we are looking for. And it is 1 plus R raised to power minus N. Okay, and therefore we repeat everything for all of the processes here. Okay, now we can seek it again. Go seek, I go to data, what if analysis, I pick seek. And what am I seeking is this negative 740, how it can become a 0. And in that case, I change the cell. And what cell am I changing? My go seek cell. And what do I have? It's giving me the rate to be 18.754%, which is what you have here. Okay, and I can also use rate function. Again, I call up that function. I need the number of tenor, which is 4 years. I need the payment. The payment I need is interest. Each year, I pay interest of how much? I pay interest of 18% of 1 million. Now, what is my PV? My PV is 980. How do I get 980? Is that 1 million? Let me link it. Multiply by, or I can use minus 2%. Multiply by that 1 million. I remove 20,000 and give me 980. What is my future value? My future value is the amount I have to pay at the end as a balloon, which is the loan amount, and the type is type 0. And therefore, what do I have? I have the same 18.754%. And likewise, I can use IRL. And in that case, what do? I pick all of the cash flow from 0 to N, and I get the same thing. Therefore, these are, no matter how complex your instruments are, once you can build a schedule for it, or you can build a timeline for it, you get what it is. Now, since we've done that, we can now proceed to what we want to do today. And what we want to do today is to start with issue that borders on impairment of financial instruments. Any question before I proceed? Any question before I proceed? Any question before I proceed? Okay, I can't see any answer. Okay, therefore we can proceed to our discussion here. Okay. Now, we'll be looking at impairment. And when we talk about impairment, what are we talking about? We are simply talking about possible losses that a financial asset might be exposed to, which means when you invest in bonds, you give out loans, you invest in commercial papers, you have trade receivables, all of these constitute financial assets. And the question then is, you believe you'll be able to recover all of these amounts over the duration that has been agreed, because most of these are debt securities or instruments. Now, at the end of the day, there is a possibility, which is also proven by historical data, that you might not be able to recover all of these monies that have been invested, which means if you buy bond, there's a possibility of default after a certain period of time, whereby you might not be able to realize your money in full. And the question then is, there's an expectation that there might be losses that is incurred in the course of holding financial assets. Now, the next question we then need to ask ourselves is, how do we more or less preempt these losses and cater for them based on the prudence concepts or based on the principle of conservatism? And that is what gave birth to what we call impairment assessment. Now, the methodology under IFRS 9 is different totally from the methodology you might know under IAS 36, which is for normal tangible and some other intangible assets. Now, for financial assets, the methodology is slightly different. And this methodology is simply wrapped on that what we call expected credit loss model, okay, ECL, okay? And this model we apply to any category of financial assets that are measured at amortized costs primarily, to some that are measured at fair value to OCI mandatorily, majorly for debt security, and in extreme situation, maybe can affect equity, but very rare, or because impairment loss on equity, if recognized, may not be able to reverse. And in that case, you rather recognize it as a fair value change. Okay, but for those that are more or less debt security inclined, they are much more likely that you recognize impairment loss on such debt securities. Okay, and it does not apply to financial assets that are measured at fair value to profit or loss. They are also applicable to some extent, probably that scope is much more scoped at higher level to loan commitments and the like. Okay, but there are two methodologies that are applicable in line with IFRS 9. Okay, the first methodology is what we call the general approach. Okay, the general approach is a methodology that tends to, first of all, assess what level or what bucket does the financial asset fall into. Okay, there are three stages under a general approach, and we're going to look at them. Okay, the first stage is the stage where all financial assets fall into at original point of recognition, or what we call initial recognition. And the second stage is where we start to experience credit deterioration, where there's an significant increase in credit qualities, which means the risk is becoming very high, and therefore you graduate from stage 1 to stage 2. And stage 3 is where we have credit default securities, which means those that have demonstrated virtually all of the features of defaults. And in that situation, that is the last stage, and which is the worst stage. Now, this stage 1 to stage 3 under the general approach is not necessarily a transitioning stage. What does that mean? It does not mean that in getting to stage 3, you have to move from stage 1 to 2, and therefore from 2 to 3. No. There's also possibility that you can move from 1 to 3 directly. And it's also possible that you can remain in 1 perpetually. It's also possible that you can move from 1 to 2 and stay in 2 perpetually. And it's also possible you can move from 1 to 2 and probably move from 2 to 3. Okay. And again, as you move up the ladder, there's also a possibility that you can move down the ladder. What does that mean? It means that even when you move from stage 1 to 3, when your condition improves, you can move back from 3 to 2, or you can move back from 3 to 2 to 1, or you can move back from 3 to 1 directly. Okay, which then means that is a condition precedence, is a condition also subsequent that will determine your movement along that ladder, whether upward or downwards. Okay, but the word expected credit loss, as I've said earlier, anticipates the possibility of loss, which is your inability to recover the current amount of your investments in financial assets in totality. Okay, this is not necessarily meaning that the default events have happened, but they are already preambles, preliminary event that is suggesting the possibility of default. And at the barest minimum, even where there's no potential of default, you still fall in bucket 1 on an aggregate level for you to be assessed for impairment, which is the elementary bucket. Okay. Now, there are 2 ways to which expected credit loss is determined under the general approach. The first one is by way of 12-month ECL, which means 12-month expected credit loss. The second one is much more by full, or what we call a lifetime expected credit loss. And what is the difference? The difference is that a lifetime expected credit loss has considered all possibilities of losses and events that could trigger such losses and of such recoverability or otherwise over the remaining life of such financial assets. Whereas a 12-month is looking at a part of the life of the asset that is no more than 12 months occurrence, and whatever will happen in that situation, therefore you consider what is the loss attributed to the next 12 months before your renewed reassessment. Now, one thing I can deduce from that is that when you assess a company to lifetime expected credit loss, the impairment loss is more likely to be higher than when you assess it based on 12 months. And the reason being that for you to have assessed under a lifetime, it means there have been much more of a default, unlike where you are assessed under the 12 months, which much more is still towards your early stage in the cycle of it all. Okay. Also, let's now break it down further. Now, okay, in case you want to know what are the events that can trigger that there's a default or there's a potential default, okay, one of them is where a borrower may experience significant financial difficulties. When a borrower has breached a contract, thereby defaulting partly in interest or interest and principal, or principal as the case may be. When the lender, which is you that you are giving out the loan, start to give unnecessary concession to extend the repayment of that loan, or you find yourself in a situation where you observe the financial difficulty of the borrower, and then now have to give some terms in terms of write-off a little and some other. These are events that may trigger such. Also, when it becomes probable that the borrower is declared bankrupt, and you understand the principle of bankruptcy. Also, where the market in which the bond probably operates, activity in the market scales down or disappears, which shows people have run away from the company based on its challenges. And therefore, this can also be a trigger. And much more often, when you purchase or at origination, you have a financial asset that is sold much more in deep discount, which shows that this might have reflected some level of expected or incurred credit losses, as the case may be. And in that situation, any of these or combination of these are trigger to the fact that there is an impairment of a financial asset. Now, key terms that you need to know, which we've used some of them in the past, and I'm going to reiterate them again here, is that when you hear things like credit impaired financial asset, what does that mean? It simply means financial asset is credit impaired when one or more events that I've discussed earlier had occurred and may have an impact in the future cash flow that will flow from that financial asset. Also, when we say credit loss, what do we mean by credit loss? We are talking about the expected shortfall in the contractual cash flow. You have agreed cash flow to be received of 180, 180, 180. But it's more expected that with the challenge the company is facing, probably for the remaining time, they can only be paying 100, 100, 100, which means what you have to collect will always be shortfall and be deferred into the future. This means that such a shortfall is expected as a credit loss for now, which you might recover if the condition improves, or you recover upon realization of the collateral, if any, or upon condition that the company rejuvenates or resurrects from its dilemma. Now, what's the difference between credit loss and expected credit loss? Okay, expected credit loss is now where you are factoring in the following attributes. You factor in probability of occurrence, okay, and you are factoring some element of time value. Now, in this case, we don't consider expected credit loss as much more the weighted average credit loss with respect to the risk of default, which is the probability of default occurring based on weights. And we're going to see some of them today. Okay, and also what is lifetime expected credit loss? It's the same thing as credit loss, but in this case, it has considered all possible effects or default events that may arise and the possibility of the maximum losses that you, the holder of financial asset, may bear in the course of holding that financial asset over the estimated life. Okay, when we also talk about past due, we are talking about a situation where financial assets, an agreed contractual timeline has failed to be met up with. What does that mean? I've agreed that every 31st or 30th of a month, I'll be paying you back so amount. But 30th has passed. We are now on the 5th of the next month. I've still not received it. Therefore, it means that amount I've not received is already a past due obligation. Okay, because as at the due date, I've not received it up to the moment. Okay, and the last one here is the purchase or originated credit impaired financial assets. And these are financial assets that at the point of you acquiring them, at the point of you purchasing them, they are already credit impaired. Okay, which means, for example, you might be a company that specializes in buying bad debts. Every bad debt you buy is credit impaired at origination, or because it's already bad, but you like buying them in order to turn them around for a gain. Similar to what ANCOM does, Asset Management Company of Nigeria, where in the past, they bought over delinquent loans from the Nigerian banks, and they specialize in turning it around in order to make gain. Therefore, every loan that originates within AMCOM are considered credit impaired financial asset at origination or at the point of purchase. And that's what that means. Okay, now I've discussed all of these principles. Now, the critical issue here is that fundamental supportive principle for expected credit loss model is based on the following fact. That one, that your financial statement should reflect the general pattern of deterioration or improvement in your credit quality of financial instrument. And secondly, that every action of yours to estimating expected credit loss should be supported by reasonable facts and sufficient information, okay, without undue cost. And this is such that you consider your historical data, your current condition, and your future expectation in doing all of this. And we're going to see that as we move on. And at every reporting date, you have the responsibility to update this fact. And those are the things that brings about changes in impairment assessment on a yearly basis. Remember, at every reporting date, you have the responsibility to more or less reassess the impairment condition and to see whether it is now improving or is further deteriorating or it remains where it is at that point in time. Now, as I've said earlier, the general approach is more or less divided into 3 stages. Stage 1 is where the financial instrument whose credit quality has not significantly deteriorated since the initial recognition. That is since the point we became party to that transaction. Stage 2 deals with financial instruments whose credit quality has significantly deteriorated since the initial recognition. And stage 3 is dealing with financial instruments where we have objective evidence to show that there's a default event. That means default has occurred. And default has occurred when I explained it earlier. You can't meet up with your payments in full or in part. You are having past due obligations extending beyond necessary, probably a threshold of 90 days or 60 days as the case may be, and the likes. This shows that you belong to stage 3 in that manner. Now, this is what I've just tried to put up to summarize that methodology to us for better understanding. Now we'll look at it carefully. Stage 1, stage 2, and stage 3. Now, under stage 1, okay, before under stage 1, I want to answer this question. When and how is impairment recognized? It varies from stage to stage. Now, under stage 1, you recognize your impairment at initial recognition and subsequently if no significant deterioration in credit risk, which means from day one, you are already estimating the likelihood of non-recoverability of certain portion of your investment in financial assets. Stage 2 is saying that you need to now assess impairment further under this stage when you start to experience significant increase in credit risk or credit deterioration. And one of those things that you can use as a measure is if an obligation is due and those obligations are not met in 30 days, which means if it's more than 30 days past due, it becomes a problem. It becomes, this is severe issue. And therefore, you fall under that stage in that situation. Otherwise, if your case has become a colossal loss, you fall under stage 3, where there's an objective evidence of impairment has occurred or default event has occurred. Now, if that is the case, then how is credit loss recognized? Expected credit losses are recognized based on this principle. Stage 1 will be based on 12-month expected credit loss model, which I've explained, which means you are only assessing that, okay, in the next 12 months, what is the possibility of non-recoverability, and which is always lesser than a lifetime. But when you get to stage 2 and stage 3, you must use a lifetime. And a lifetime means you are considering all possibilities of default events across the remaining life of that financial asset. And to the degree or to the extent of the entire carrying amount, you recognize your expected credit loss in that regard. Now, finally, how is effective interest rate computed or calculated in this case? Now, when you have your effective interest rate, which you have already seen how we can determine them, for you to determine your interest accrual, interest income accrual every period, for stage 1 and stage 2, you apply the effective interest rate on the entire gross carrying amount. And what is gross carrying amount here? It is the carrying amount or the amortized cost of that financial asset before any allowance for impairment is deducted. Okay? And if you remember all what you have computed in class about amortized costs, those amortized costs you see are amortized costs assuming there was no impairment. And those are what we call the gross carrying amount for this purpose. Now, whereas when it gets to stage 3, you are not going to apply it on the gross carrying amount because there's a default already. And therefore, what you are expected in that point is a salvage, not to even accrue more interest, which means technically interest will be suspended, but you will only recognize interest to the tune of unwinding of the discount inherent in the net carrying amount of such financial assets. And what does that mean is that ERR is calculated upon the net carrying amount of a financial asset that falls under stage 3. And what net carrying amount signifies is simply the gross carrying amount less the cumulative expected credit loss allowances in form of impairment losses that have been aggregated over time on that financial asset. Okay, as I've said also, we'll find out that our methodology of expected credit loss is premised on the following variables. 1, expected value. Now, expected value, if you could go back to performance management and probably financial management, is simply where you have different state of the nature or state of the world, which is based on probability. And therefore, you have event 1 possible. If 1 does not happen, event 2 may happen. If event 2 may not happen, event 3 may happen, up to event 4, like that. Now, you assign probability or weight to them of the likelihood of occurrence. Now, the sum of the weights on those outcomes is what we call expected value, which means they are much more probability weighted outcome. Okay, and let me show you in Excel what I mean by probability weighted outcome. let's say we have states of the world with different transportable outcomes. You have most optimistic, most likely, and most pessimistic. These are possible outcomes. And based on various statistical methodology, we have assigned probability to them. And let me say this is 0.3, 0.4, 0.3. And remember, the sum of probability must sum up to 1 or 100%, as the case may be. Now, let's say this is the credit losses based on each one. Most optimistic, let's say the credit loss is just 100. Most likely, let's say, is 300. And the worst case scenario, let's say, is 700. Now, what then do we do is I would say our weighted average, probability weighted average, which is our expected value, is the product of this probability and the credit loss. This is 30. The other one is 120, which means when we sum it up, our weighted average loss, which means our expected value, is 60. That's what we mean by what I've explained, which means given different possibilities and this probability, this is what we recognize eventually as a credit loss. Okay, now let me go back. The other thing you consider is time value. Okay, remember, anytime we are talking anything about the future, we always consider time what? Value. And if that is the case, we then need to look at the effect of time value. And lastly, we look at data with respect to historical data, which shows us patterns, current data, which shows us current condition, and future estimated or forecasted data, which give us our future expectation. Okay, now let me also come back to my Excel to analyze something here. Which means at the end of the day, expected credit loss ECL is determined under this general principle. What's the general principle? Is that ECL is a function of PD EAD and LGD. What do they mean? PD equals probability of default. EAD is the exposure of default, which equals the carrying amount of the financial what? Assets. At default, at the time of default. And LGD equals loss given default. That is, what is the rate out of 100% of what is defaulted upon? What portion of it is lost and what portion of it is recoverable? And this is always equal to 1 minus the recovery rate. And what is the recovery rate? Which means wherever there's a default, what percentage of it can I salvage compared to what percentage will I lose? Okay, and those are the functions here. Now, you now put something there invariably, time value of money. Where discounting principles will be applied. Okay, which means that in that case, it is the sum of whatever we have that we get here in this case. Now, probably after break, I'll get my pen so that I can write vividly. If I'm to use my mouse to write here, I might not write effectively. Okay, let me see whether I can still manage to use it to write. Okay, which means my ECL probability of default, exposure, and default, and loss given default. And what's time value of money? Counted with 1 plus what? EIR, which is the R, raised to power N. Okay, that is that. Okay, we are going to see that as we move on. Any question at this point? Any question at this point? Any question at this point? Show it up by raise of hand, or at least by sending a chat. Okay, since there's no question, okay, let's go back to my presentation. Okay, this is the bucket I was saying. How you can move from one bucket to another. Okay, and changes. If your condition deteriorates, you move across the bucket. If your condition improves, you move back along the buckets. Okay, now let's now go into test our understanding. But before then, okay, let's test our understanding on that first, before I now come to simplified method. Remember, there are two methodologies. The default methodology is the general approach. The exception to the general approach is a simplified approach, where we'll be looking at one of those methods in simplified approach, which we'll call provision matrix. Okay. Now let me go back to our question. That's a question. Okay, can somebody volunteer to read this problem? Yeah. Question 8. Who volunteered? Okay. IBM. I can't see your hand again. Okay, Maiwa. You can mute. Over to you, Maiwa.
Asaminga purchased.
Okay.
Asaminga purchased 5% bond in Jose Mario, April 2017. Into brackets in the primary market for 1 million naira. The indenture that is terms of the bond issued was 5 years maturity with a value of 1,305,350. The effective rate of interest EIR on the debentures and the IFRS 9 conditions are satisfied for the investment to be carried out at amortized cost. As of 31st March 2019, filed for bankruptcy and immediately went into liquidation. All interest had been paid until that date. On 31st March 2019, the liquidator of Jose Mario had announced a reduction of remaining interest by 40%. Value of the bond will be paid upon realizations of the assets of Jose Mario, which they expected to coincide with the original repayment cash flow dates. The market interest rate of a similar bond is 8% on that date.
Continue. You can continue. My one, required. Are you there? Okay, who want to continue for us?
I'm done, sir.
Okay, required. We can't hear you all through. Start from required.
All right, required. What would have been the carrying amount of the bond just prior to when it is evident that impairment of these investments are set in? B, considering the possible impairment of the investment, what would have been the amount to be recognized post
Okay, are you done? Okay, can you guys hear me clearly? Just signify by chat. Okay, thank you. I've seen a response. Thank you clearly. Okay, now let me read the requirement. It seems the network was poor at its side. The requirement says what will have been the carrying amount of the bond just prior to when it is evident that impairment of the investment are set in. That is what is the gross carrying amount. That's what they're saying. And B says, considering the possible impairment of investment, what will have been the amount to be recognized post-impairment, which means they are looking at the net carrying amount, which means the gross carrying amount less the impairment. Now, C says, if any, how will the impairment loss be reported in Asenwenga's financial statement for the year ended at 1st March 2019? Okay, now let's do the needful. Now I've tried to copy the question. Let me copy the concluding parts. the requirement. Okay. Okay, I think that's okay. Now let's extract information. The information is that Wenger purchased 5% bond in Morino. Bond amount. Okay, how much is it? 1 million. Transaction cost, no transaction cost, that is 0%. The coupon on the bond was 5%, yeah. The duration is 5 years. The bond will be redeemed at a premium. Why is it premium? Because it's above the 1 million, which means redemption value. $1,305,350. Okay. Effective interest rate, will determine that ourselves. Effective interest rate. Though it was given to us, let's see whether we can use the opportunity to determine it. It was given at 10%. Let's do that test first. Now, this is 5 years. Let me drag it down. That's the bond amount. Now it's investments. Remember, if it's investment for actual asset, you add the fee, add transaction fee or cost. Remember the explanation I gave to you in class? Because instead of expensing it, you are capitalizing it along with the investments. Okay, now this is 1 million plus transaction cost, even though it's 0%, but let me just leave it as a template, which is 1 million. If there's a 1% transaction cost, it means you capitalize the 10,000 in it. That's what it means. In this case, I revert to 0. Now, this is coupon only. And in year 5 is coupon plus the redemption value. Sum it up. Now, since we are investing, I'll put it in negative. It's outflow of cash, I mean. Okay, what's my coupon? I'm expected to earn coupon of how much? 5% multiplied by the bond amount, the face value, which is 50,000. And I'll have 50,000 for 5 years. Sorry, I didn't lock it. I'll have 50,000 for 5 years. And in the 5th year, I'll still get back my redemption value, which is at the premium. Let me emphasize, it is the face value plus what? Premium. What's the face value? Let me write it there. And premium of 305, 350. Okay. Now, what then do? I need my effective interest rate. I can use rate function. This is the last time we'll be using it. Again, what's the tenor? 5 years. What are the payments? The payments are 50,000 each, which we've gotten. The PV, how much am I investing now? I'm investing 1 million. Net position. What's my future value? My future value is I'm getting back this amount. And it's at the end of the year. And that should give me, where's the error coming from? What have I typed wrongly? 550. Yes. What's this? Okay, yeah. Sorry, I made a mistake. It's already negative, and I'll put it as negative again. Okay, it's negative. Therefore, that gives us the 10% you saw in the question. That's the same 10% you saw in the question. Now I can do go seek. If I'm doing go seek, I construct this, my discount factor 1 plus n. What is my n? I put the blank raised to power minus n. Okay. Now my go seek is to go to my data and go to my what if analysis. I want to make this 0. And what am I going to influence? It's my ERR. And that gives me the same thing. Okay. Now, and I can use XIRR or IRR. And I just pick. And it gives me the same thing. Okay, in case you find yourself in a situation where you are using spreadsheets, that's what you do. Okay, but in this case, you don't need to have done what we've done because it's already given to us on a platter of gold. Therefore, what do we need to do is that A, in answering A, the gross carrying amount of the bond is as thus. And you construct the amortized cost schedule. Here, 1, 2, 3, 4, 5. Amortized cost as that. Interest. Now, because it's investment, it's income, interest, income based on ERR of 10%. These are cash flows. And these are amortized costs. at the end. All things being equal. Okay, what's my initial amount? Is whatever I have here, which is the 1 million. Now I have my effective interest rate, which is 10%. I can just use what I have here to give me exact 10%, multiplied by whatever the opening balance is. And all figures, I can put it to the next decimal number. Okay, my cash flow is this, and what's my amortized cost at the end? It's just the sum across. Since I put negative in my cash flow, and this is simply my gross carrying amount at the end of year 1. But that's not the question they ask. They ask us at the end of year 2. Okay. I link this, and I can drag down. Every other thing I can drag down. And you see how Excel, imagine you are using Excel in the exam, you don't need to be wasting time. Everything drags down in that manner. And that is it. Now, the question is, if you have to look at what is our year 1? My year 1 runs from 1st of April 2017 to 31st of March 2018. My year 2 runs from 2018 April to 2019. Okay, and this is what is key for us. That's what the question wants from us. That's at 2019. Okay, which means what is my value there? I can see it here. This is it. That is it. Now, which means my answer is that as at 31st March 2019, the gross carrying amount of the bond is 1,105,020 naira. And that's just the answer. That's the answer. Okay, now B says what? B says what is the net carrying amount? Of the bond. Now, to determine that, we need to now find, to determine that, let me just create something here. It is the gross carrying amount as at 31st March 2019 less the expected credit loss at that same date. Okay, now we already have the plot kind amount with this. What is missing is the impairment loss, and therefore we can go and look for the impairment loss. Now, take note in exam, this area is not needed. I only completed it for you, but it's not needed. Let me try and put a sign there. Don't waste your time in exam for it because it's not needed. You have to be like that. Okay. Now, how do you determine our impairment loss? It's what we need to do. Therefore, we need to, step one, ascertain impairment losses or expected credit losses, ETL, after 31st March 2019. Therefore, what do we do? Step one, estimate the future cash flows to be recovered immediately after the observed default events. You know what the default event is in the question? What happened to Joseph Mourinho? Okay, how do you do that? Go back to the question. They said after 31st of March 2019, Jose Mourinho had filed for bankruptcy and immediately went into liquidation. All interest had been paid up to that date, which means everything here was not of a problem. But immediately after, the liquidator of Jose Mourinho has announced a reduction of the remaining interest by 40%. What it simply means is that interest in year 3 it's 100%. What is our interest normally in year 3? Our interest in year 3 is supposed to be 50,000. Let me use coupon. Or let me slash it. Coupon interest. Is 50,000. Now we can't recover it in full. We can only recover 60%, which is 100% minus 40%. Because the phrase used there says, Jose Mourinho has announced a reduction of remaining interest by, he didn't reduce it to, he has reduced it by, which means 40% is off based on the reality of the company. What does that mean? It means 100% minus 40% will give you 60%. Now, 60% is what you recover from interest. What is our interest in year 3? Is this. Also, the same thing is for year 4, okay? Which means year 3 to year 5, you recover that. And in year 5, you also recover the redemption value. But to the tune of what? They said, and that only 80% of the terminal or maturity value of the bond will be paid upon realization of the assets of Jose Mourinho, okay, which is expected to coincide with the original repayment dates. Now, what simply means that not only that they have head costs on our money, but we are also going to get it at those future dates already predetermined, which means for redemption value, 80% of it is what we get. 80% of how much is redemption value? 1,305,350. Therefore, 80%. This is what we get. Now, all figures in Naira, okay, presumably. Now, the step 2 now is estimate the credit loss. The credit what? Losses. Now, how do you estimate the credit losses? I can do it by saying, okay, in each year, year 3, year 4, and year 5. What is our normal future cash flow? What's our contractual cash flow? We'll compare it with our expected cash flow now. We now have our credit loss. What is our contractual cash flow? This is what we expected to get before. Year 3, coupon only. Year 4, coupon only. And year 5, coupon and what? Redemption value. Now, what can we get now? We can only get coupon of 30 in year 3, coupon of 30 in year 4, and coupon of 30 plus redemption value of 1,044,280 in year 5. Therefore, what are the shortfalls in our cash flows? The difference between this and this. And that gives us that. Now, sorry. Now, these are our credit losses or shortfalls. Okay. Now, step 3 is to consider the effect of time value of what? Money. Because giving us the money today is not the same thing as giving us at future date that was initially agreed, assuming there was no impairment, which means on 31st of March 2019, the liquidator of Dos Moreno had announced a reduction of the remaining interest by 40%, and that only 80% of terminal maturity value of the bond will be paid upon realization or upon disposal of Joseph Moreno's assets, which is expected to coincide with the original repayment cash flow dates. And that is that. Okay, well, that means I'll now come here and say here. Now, though it is year 3, year 4, and year 5, but the period is period 1. The period is period 1, 2, and 3. Who can tell me why? Let me put this question to you before I answer it. Though we are in year 3, we are considering year 3, year 4, year 5, but why are we using period 1 to 3? Who can answer that? Okay, somebody said I should please check the premium and retention value, sir. What is wrong with that? Oluwatobiloba, sorry, you can raise up, you can give me access to mute. What's the issue, sir?
Okay, initially I thought it was just 1,305,350, but I later discovered that we have added the coupon on it. That's
Yeah, we have
50,000.
added.
So I
Okay,
thought it
this
was a
is what you are saying. This is it.
yes,
Yeah,
yes, sir.
it is coupon plus redemption value. It's still correct.
Okay, sir.
Plus redemption value. Thank you.
Yes, sir.
Okay, who can give me the answer to my question? If you get it right, you win a prize. Raise up your hand. The first to get it right. Why are we looking at period 1 to 3 instead of period 3, 4, 5, given that the year is 3, 4, 5? Any hands up? That is when the impairment occurs. I didn't get that. Let me give you unmute, Kalu. Explain yourself. I didn't get that. That is when the impairment occurs. Can you explain it?
Okay, I mean, we're looking at 3, 4, 5 because from the question, we understand that after the second year, that's when the losses for the interest and the redemption value occurred. Could that be?
Okay, let me explain it. Okay. Now we are considering impairments based on future shortfall from year 3 to year 5. But at what point are we considering that? We are considering that at the standing point where we were at the end of year 2. Now, today is 31st of March 2019, based on the information. We are now at the end of year 2. Now, we are now looking into year 3, year 4, and year 5. And how many distance do we have from end of year 2 to year 3? Is 1 year distance. From end of year 2 to year 4, 2 years distance. And from end of year 2 to year 5, 3-year distance. Okay, which means partially, I'll give it to you. See me tomorrow. Is that okay? Mr. Kalu. Thank you. Okay, I think that I've addressed the question. Therefore, I'll come here with the credit losses or shortfall. And I bring them here. and apply the discount what? Factor. And you are going to use your original effective what? Interest rate, which is 10 what? The 8% they put there is not required. They only use it to deceive you. You don't need it. It's not relevant. It's not what? Not relevant. It's not relevant. Okay. Therefore, what's my discount factor? 1 plus R. What is my R? 10%. Raised to power minus what? N. And this period is very key so that you don't get it wrong. And what is my present what? Value, which is also expected value in this. Just multiply. And what is sum? Therefore, all things being what? Equal. The sum of what I have here is my expected credit loss. Or what you call impairment loss. Okay? As such. Therefore, I can now come back to my question. To say, expected credit loss we have is this. All things being what? Now, my net carrying amount is not this amount. And that answers. Now, see. It says treatment of impairment losses. In the financial year ended 31st March 2019. Okay. The treatment is a function of the movement between the ECL allowance, or what some of you will call provision, which is not appropriate, allowance for impairment losses, or ECL as at the beginning, which in this case it's a year before now, at 1st March 2018, if any. You now compare it with allowance at the end of the year. Now, the end of the year is what we just completed, which we know. We will now have to compare it with the beginning. Now, in this case, they didn't give us any opening balance. We assume it is 0. It then means that we will now ask ourselves, see this impairment allowance, or what you call provision sometimes, as a liability in your head. And it was 0 before, it's now 245, it's increasing. Therefore, it means you are incurred losses, more losses than what it is. In that case, you now come here and say, there is what? An impairment loss or charge for the year. Now, depending on the movement, it could also be impairment gain. Okay? Impairment gain reflect more of reversal of earlier recognized impairment losses. Therefore, what has happened is that once the balance at the end is more than the balance at the beginning, you are incurring additional loss. But once, let's say at the beginning we have 300,000, we have 300,000, it means you have a gain. But again, you can't recognize impairment gain more than earlier recognized impairment losses. This is synonymous to the same thing where you look at evaluation gain and impairment. Okay, that's what you need to look at. Which means, and also if what you have before is 100,000, it means you are recognizing additional 145 to make it 45. But in this case, it was 0, no figure was given. It means we are recognizing the entire 245, which means in the financial year ended at 4th December 2019, the company would have to recognize the sum of 245,874 as an impairment loss in the profits or loss. Whilst a corresponding reduction in the financial assets, that is the bond value. The bond carrying plus carrying amount. In the statement of financial position. That's it. And that's the answer you need to give. Okay. You don't just show accounting numbers, you provide narratives. That's what they ask you to do. Okay, if I want to do accounting entry now, I can further buttress it with accounting entry. Debit, my profit or loss with impairment charges, and credit my 5% bond, which is a financial asset. compute the sum of 345, 874 gain impairment, gain expected credit loss. For the year. Now that answers the question. Any other question? That answers the question. Any other question? Any other question? Okay, it seems you guys are flowing. Okay, that's how we answer that question. Okay, now we'll be looking at simplified approach. Okay, what is simplified approach? We are going to look at it. Let me switch back to my slide. Or to my question. Who will volunteer to read this question so that I can use it to explain the simplified approach and why such approach is considered applicable where there's expedient, there's practical experience to do so in that case. Anybody to read this question, volunteer? Volunteer? I can't see any hand. Who wants to read at this time? Okay, I'll call someone randomly. Z, who is Z? Z should read. Z. Okay, so Z should read. Is Z there? Z, I've given you access to read.
Green Finance Limited is a service organization involved in specialized training. The company has the following mix of trade receivables, which are outstanding along with different dates. That is, some receivables are currently due or past due and other not yet due, as at the reporting date 31st December 2019. The average credit day for every trade receivable is 30 days. The schedule below represents the distribution of the trade receivable from the invoice dates. Grouping invoice dates, invoice amounts, outstanding balances. We have A, B, C, D. Then for A, the invoice dates 1st March 2019. Invoice amount 1 million, outstanding balance 120,000. For B, invoice date 4 May 2019. Invoice amount 800,000, outstanding balance 100,000. For C, invoice date 10th September 2019. Invoice amount 500,000, outstanding balance 200,000. For D, invoice date 26 November 2019. Invoice amount 1,200,000, outstanding balances 320,000. For E, invoice date 10th December 2019. Invoice amount 600,000, outstanding balance 450,000. The loss rate as estimated by the management of the company based on historical data of actual loss collection is as shown below. Loss rate.
Can you talk about the loss rate?
Sir?
Cotton, can you read the loss rate out per past due date?
Loss rate past due days. Current 0% current, 2% 1 to 30 days, 5% 31 to 60 days, 10% 61 to 90 days, 40% above 90 days. Required based on a practical expedient and the adoption of the simplified approach, that is provision matrix, in accordance with the requirement of IFRS 9 by the management of the company. What will be the amount of allowance for credit losses as at 31st December 2019 to be recognized in the balance sheet and statement of profit or loss, given that the closing balance in the allowance accounts for credit losses as at 31st December 2018 was 124,000. Please show the accounting entries, assuming 30 days makes a month.
Okay, thank you very much. Thank you very much. Now let me switch to the Excel. Okay, now the same thing you have is what is in the Excel now. Okay, we have the grouping. Now, these are different customers, and each customer has a credit they have credit days according to the question, and some of them have already past due days. Now, why is it past due? If you go back to the question, they said for each invoice, you have 30 days to pay. If you have 30 days to pay, it then means, for example, the invoice A, let me highlight. Now, the invoice A, which was issued 1st of March 2019, should not elapse beyond 30 days, Abby. Now, let me do it like this. Let me copy it out. And let me put due date beside it. Due date. Which means what will be the due dates for each one of them, considering 30 days payment grace period. It will be, let me just add 30 days to each one of this. This should have been paid by 31st of March 2019, like this, okay? Now, we are reporting as at the end of the year. What's our reporting date? 31st of December 2019. Therefore, let me put my reporting date beside, and let me see those that are still owing. My reporting date is 31st of December 2019. For everyone, the question then is, what is my past due date? Past due days, which means how many days has elapsed between these due dates and at the end of the year is the difference between the due date and the reporting date. And I'll measure it in D. D means days, M means months, and Y means what? Year. And therefore, this has taken 25 days. 75 days later than necessary. Now, what about other ones? It has taken, and this one is showing not because this one is not yet due, which means I can change the formula to if this is if error. Okay, let me just put this. If this is let me use if error condition. If error, return not yet past due. Okay. Now, which means the last one is not yet past due because this date is still a future date. This date is still what? A future date. Now, anyone that's not yet past due is what we call current. Why anyone that is past due, we need to group them into this bucket. Is it past due between 1 day and 30 days? Is it past due between 31 days and 60 days? Is it past due between 61 days and 90 days? Or is it past due above 90 days, depending on the company's policy about trade receivable and credit? Now, in this case, we can now come back and say, let us place them where they belong. Where do they belong? Group A. Where does it belong? Group A is 275 days. 275 days belong above 90 days. Okay? Therefore, I will open the category. What category is it? 75 days above 90 days. And you can see the formula I use there is different. But to break it down for you, that's why I use this other one-by-one formula. But if you are somebody that is mathematically inclined or you're a modeler, you can build a simple logic. One simple logic will answer my question instead of breaking it down into multiple steps. Okay? Therefore, it falls above 90 days. Now, B is 211 days. It still falls above 90 days. Okay? 82 days for C falls within 61 and 90 days. B falls 5 days. 5 days falls between 1 and 30 days. Why the last one, not yet due? Not yet due fall under current. I'll put that in green. Not yet due, or let me put it in blue. Not yet due fall under what? Current. Now, what does that mean? We'll now bring the kind amount down, which is the same thing as the exposure at what? Default. EAD. Now, what has happened in this case? We need the loss rate. This loss rate is determined scientifically based on roll rate and some other methodologies, which is outside the scope of your program. But in real life, we develop model to determine this. These are sophisticated and robust model in that case. But for examination, they will always give it to you. But in the immediate future, probably when they move to computer-based exam, where you have access to spreadsheets, therefore, we can start to do it in real life for you to see and how you can do it in the examination. Okay, but for now, we'll just give you the roll rates. And what I'll just do is to transpose this roll rates and give it to you as follows. Now, the roll rates is upon what group you fall into. For everything above 90 days is 40% from here. Everything within 90 days, 61 to 90 days is 10%. Between 1 and 30 days is what? 2%, and current is 0. What simply means here is that based on the estimation, they found out that it's more likely that when you fall in this bracket, this is the maximum loss we experience. And that's what we call it loss rate. Sometimes you can call it loss roll rate. Now, what is my ECL? My ECL is simply the product or the multiplication. The product of my ECL, of my loss rate and the exposure at default. In that case, what do I have? I have 48,000, which means I multiply 40% with my carrying amount. And thereafter, the amount I obtain here is 114,400, which is a balance sheet item. Okay? But the question you require also is to say, what then is the impact in the profit or loss for the year? How much impairment loss or gain are we going to recognize, given that our allowance for credit loss as at the end of last year, 2018, which you can see here, was 124. And that is what you find in the question. Okay, but what we have as at the end of 2019 is 114,400. Therefore, let us now pair the two together and see whether you have a gain or a loss. In this case, what we have as at the end of the year is 114. What we had at the beginning is 124. It means we are reversing out of earlier recognized allowance for credit losses, and which shows that we have impairment gain in this case. Okay, which means impairment gain would not be recognized in our income statement in that manner. Okay, and you are going to recognize that. How much are we recognizing? There's an impairment of 9.6 being the impairment gain arising from trade receivable. And this is a simplified approach that is only applicable for trade receivable without financing component compulsorily. It's also applicable to lease receivable, where you have taken an option to do so as against following general approach. It's also applicable to contract assets under IFRS 15, provided they have no financing components. But where they have financing components, you have the option to elect to use this methodology. Otherwise, you fall under the general methodology, which is to group them into stages. Stage 1, stage 2, and what? Stage 3, as the case may be. Any question on these aspects? Any question on simplified approach? And the methodology we have used under simplified is what we call the provision matrix. It's what we call the what? The provision matrix. Okay, if there's no question at this point, we'll go on short break and we'll convert back by 1:20. Therefore, we have 25 minutes to go on break. Therefore, conserve your data. You can must as well probably log off and come back in. But I will not be off. I'll be waiting for you here. Thank you very much. God bless you. Okay, we are welcome back. If there are any questions before we continue, this is an opportunity to raise it once again. Any question? Can drop the question on the chat box, or you raise up your hand and I'll give you access. Okay, there's no question. Okay, I think what next we'll do also is to more or less look at this short video on something that we'll only discuss briefly, because at professional level, you discuss it extensively. Okay. We're back from that short video. Now, for the umpteenth time, is there any other question before we proceed on our discussion? Okay, let's go back to our presentation slide. Yes, as I've said earlier, Hedge accounting is a voluntary accounting. And from the perspective, it's not every entity that will apply the provision of IFRS 9 when it comes to Hedge accounting. Okay, but when you've chosen to do so, you have to apply it in all principles and practices as required under IFRS 9. Okay, and the essence of Hedge accounting is just to make you remove volatility arising from the hedge item and hedge instrument from your financial statements, such that you appropriately match the volatilities of both the hedge item and hedge instrument as they occur together, most especially the hedge item at a later date. Now, to do such, we need to first of all understand that there are three kinds of hedge. Okay, we have the fair value hedge, we have the cash flow hedge, and we also have the hedge of net investment in foreign operations. What's the difference? When we talk about fair value hedge, we are talking about hedging the variability in the prices of hedge items. Maybe changes in prices of inventory item, in prices of equity investments, or in prices of other forms of commodities. Okay. And when we talk about cash flow hedge, you are hedging against variability in cash flows attributed to an hedge items. Okay, and the last one is hedge of net investment in foreign operation. What that presupposes is that imagine you invest as a Nigerian company in the US. At the time of investment, Naira to US was 1,500 Naira. And you invested $1 million, which means you will have used 1.5 billion Naira to purchase $1 million to invest in the US. Now, imagine you now dispose your investment in the US. You invested in a company in the US where you solely own for $1 million 2 years ago. Okay, now at the time of realizing that investment, you sold that company. And probably you sold it for 1.2 million Naira, $1.2 million. Technically, you've made a gain of 20% between when you invested and when you realized. Now, but the question then is, Naira may have waxed stronger by the time you are realizing that investment. Probably Naira has gotten back to 1,000 Naira per dollar. It then means that when you are bringing $1.2 million back to Nigeria 2 years after at 1,000 per dollar, therefore your realization of investment is 1.2 million, 1.2 billion Naira. And remember that you invested 1.5 billion Naira to buy that $1 million. It means you've lost money. Now, what do you do in this situation where you expect that your local currency will work stronger than a foreign currency in which you have made foreign investment? Is for you to carry out more or less like hedge against that risk. And you can buy futures, you can buy forward contract, majorly forward contract, because it's customized and it's over the counter. And therefore, you hedge against that risk. Now, even when you have done the hedging, does not mean you apply hedge accounting, but you have more or less hedged against that variability. And that is what that simplifies. Which then means that if you have entered a forward contract at least the same 1.5, It then means that when you sell your investment for $1.2 million, you are going to still be compensated for it at the rate of 1.5, at the rate of 1,500 naira per dollar. And when you bring that in, probably you might realize something close to $2 million, 2 billion naira. Now, it means that it has protected you based on your investment. And that is the whole essence of hedging against your net foreign investment in foreign operation. Okay, now that is that. But to now fast track that, it means that what hedge accounting is trying to do is to bridge the gap between the way and manner you manage your risk associated with hedge item and the instruments you use, such as hedge instruments in managing those risks, those financial risks, with the way and manner you report your accounting. And that's why there has now been convergence between accounting principles for financial reporting purposes with the risk management principle for your hedge effectiveness. Okay? And it's on that premise that we now have a revised position of IFRS 9 with respect to hedge accounting. Okay? And the beauty of IFRS now is that before now, you cannot hedge a component of an item of risk. You have to more or less hedge it holistically or do not hedge. But in today's world, you can do that by separating the risk components and hedge it individually. Okay, in simple terms, you can't carry out hedge accounting, or you cannot apply hedge accounting if you have not met certain minimum conditions. Okay, one of those conditions is to establish that a relationship exists that made the hedging instrument eligible for the hedge item. And basically what we are seeing here is that more often is derivative or any other relevant financial instrument that can be used as an hedge item for you to qualify for this hedge accounting. Otherwise, if you use non-financial instruments or non-derivative instruments to do the hedge, you may not qualify for this hedge accounting, even though you have hedged naturally. Okay, another aspect of precondition is that there must be formal documentation that speaks to your risk management procedure, your objective, what degree of effectiveness is going to be your hedge, and what portion of the risk are you hedging? Is it going to be a partial hedge or a full hedge, and the likes? And finally, you must be able to establish a clear relationship between your hedge item and hedge instrument to the degree that determine your effectiveness, which speaks to one, the relationship, economic relationship of those two things. What are those two things I mentioned? The hedge item, which is what you want to hedge the financial risk on, and the hedge instrument, which is the instrument, usually derivative instrument or financial asset that you use as a medium of hedging. And also, you must also, to a degree, provide the criteria to determine how effective or the effect of your credit risk, what it has in dominating value of the hedge item. And likewise, what will be the hedging ratio for the relationship. And the essence of that is to determine the level of effectiveness of your hedge. Okay. And the effectiveness of hedge is much more critical when it comes to fair value hedge. Okay, because the effective portion will more or less have to be suspended, while the ineffective portion have to be recognized as a profit or loss. And when you suspend, it means it's suspended by recognition through other comprehensive income. Okay, now again, this is just a condition or a flow chart to recognizing hedge accounting. Peradventure, you want to recognize, but the recognition principle is more of principle-based than rule-based. And the clear thing is for you to answer these questions. Your answer to this question will tell you whether you discontinue or not, or whether rather than discontinue, you are only rebalancing or modifying the hedge ratio, as the case may be. And the first question you ask yourself is that, are the qualifying criteria still met? If the answer is yes, you continue with your hedge accounting. And if the answer is no, you ask the second question to say, is there any reason for failing the hedge ratio? Okay, if you have reasons to say yes, you will answer the third question that says, as the risk management objective change? If the answer is no, therefore you only just have to rebalance the hedge ratio. But if the answer is yes, therefore you have to discontinue the hedge accounting. And likewise, if your second question that says, is there any reason for failing the hedge ratio? If your answer has been no, you equally discontinue. Okay, that's just the basis of that, the recognition. And another attribute way of recognizing it is where the hedge instrument itself may have expired, or it has been transferred effectively, or terminated, or exercised, as the case may be. Okay, hedge accounting is just a way to create a suspension of the immediate impact of hedge instruments by not going to profit or loss until the effect of the hedge item affect profit or loss. That's just a simple methodology. That's just a simple objective that hedge accounting wants to achieve. Okay, but if you are not bothered about the volatility the hedge instrument will have by way of mismatching, therefore you may not apply hedge accounting. Okay, and that is just it. Okay, and hedge items are any form of transactions that have given rise to a financial risk to which you want to hedge. Okay, and why hedge instrument is much more of the instruments which are majorly derivatives of any other financial asset that you use to hedge such a risk in order to create a balance. And when we say hedging, what are we saying? So that once you have a loss from the hedge item, you automatically have a counter position, which is a gain from the hedge instrument. All things being equal, depending on your hedging ratio and your hedging effectiveness, is supposed to net off and produce a little difference, which might be a gain or a loss, depending on the way and manner you want to manage your risk. And when we talk about risk, take note that risk could be upside risk, it could be downside risk. Okay, which I mean risk is not always negative, because there is also a general principle of risk return basis. The higher the risk, the higher return. And therefore, it depends on where you want to stand so that you are more or less well protected at every point in time. As I've said earlier, we have two types of hedging relationship: fair value hedge, cash flow hedge, and the hedge of your net investment in foreign operation. Okay, now to simplify it very well is that once you have a fair value hedge, okay, the fair value gain or loss from the hedge instrument is not recognized until the effect of the fair value fair value changes in the hedge item affect profit or loss. Okay, and that's that. At this level, we won't be going granular because it's just the elementary introduction that is required at the skill level. But if you're in a professional class, we'll go deeper to also evaluate the basis of various instruments, which you can see on my YouTube video on the nitty-gritty of financial instruments. And I think that is a part 5 and part 6 video, where we go in depth to analyzing them, okay, with numbers and critical scenarios. For cash flow hedge, again, we also look at the hedging of variability in returns, in the cash flow of an hedge items, okay? And therefore, much more what you use for cash flow hedge as an instrument are usually swap contracts, or at best minimum forward contracts in that case, okay? And it's at that point you determine your level of hedge effectiveness. And the portion that goes to profit or loss, which is the ineffective portion, and the portion that goes to OCI, which is the effective portion. And the degree of effectiveness is as predetermined before entering into the hedge. And the metrics and methodology to determine the effectiveness of the hedge is more or less predetermined. And whether the hedge is going to be partially carried out or fully carried out is also predetermined in your hedging documentation. Okay, and as I've explained earlier, hedge of net investment in foreign operation, I've given you a practical scenario towards doing that. Okay, that is that. Now let me take you back to the recognition principles. Even though in the video we've add 1 or 2 interactions to that. Now, when you say the recognition, Okay, let's start from recognition, which we've done ahead of time. When you say recognition, what does that simply mean? In literal meaning, it means you are bringing into the books, into the financial statements, an item or an element of financial statement. For example, when you recognize a financial asset, it means you are recording the value of that financial asset in your balance sheet. That's what we simply mean by recognition. Okay? Now, at a point in time also, that asset may go off your book. Now, the process of going off your book is what called the recognition. That is when you have to remove the carrying amount of an asset or liability from your financial statement. Okay, what could trigger the recognition? It's a function of, is it financial assets or is it financial liability in this case? Okay, if it's financial assets, the only precondition to which you can remove the kind amount of financial assets is simply premised on the fact that you no longer have a right over the financial asset to receiving future cash flows, which means your right has since expired. And what could trigger the expiration of your right is either by way of you selling that your right because you've disposed of that financial asset, or by you transferring risk and reward of ownership to another party, or by passage of time, your right seems to have expired. Okay, and therefore, in this situation, you will derecognize your financial asset. But sometimes it might look as if you transfer the risk and reward, but technically they are still retained, but the physical item is not with you. Therefore, the question is that you have to carry out a control test. Okay, which means sometimes you may have transferred a financial asset, but in real sense, you have not transferred the risk and reward of associated with the right to receiving cash flows. Okay, similar to example we did in class where we have secured, we carry out an asset securitization, where you might have more or less used that financial asset to pledge for a loan. That doesn't mean you've transferred the risk and reward significantly. What you have simply done is that you have more or less carried out what we call a repo transaction. A repo transaction is simply called a repurchase contract, okay? Which means you only technically pledge that financial asset as a collateral to creating a financial obligation. And therefore, we may not be able to recognize in that situation if it is paramount and it's essential that we observe that significant risk and reward associated with the future right to receiving cash flow have not technically been transferred or extinguished in this case. Okay, and that is the general principle for assets. Now for liability, the general principle simply means that you remove any financial liability from your book, provided the liability has been extinguished or the obligation has been extinguished. Now, the word extinguished means the obligation no longer exists. Under three conditions will obligation no longer exist. First is when the obligation has been discharged. And discharge is always by way of settlement, which means you've paid, or when the obligation has been cancelled. Cancellation is always at the instance of the other party who you are owing, who has probably written it off for you, or who has collected a percentage of it in full and final settlement, or by way of court order that says that liability is no longer valid and it has been extinguished. Okay? The third aspect is when the obligation seems to have expired. And the obligation expires majorly by way of passage of time. And those are these conditions that you need to take note of at every point in time. Okay? And all of it, you find it in the material which I've explained in Gardner way. Okay, and that is that. And the issue is where you recognize financial asset or financial liability, primarily the gain or loss associated with such financial asset or liability, regardless of the classification, are usually recognized in the profit or loss. The only limitation is that other than for debt security, for equity investment in which you measure at fair value to other comprehensive income, the gain or loss arising from such recognition, okay, such reserve that you have created by way of fair value reserve from through other comprehensive income may not be reclassified to profit or loss, rather may be reported to retained earnings directly. Okay, but any other gain or loss arising as a result of the derecognition, being the difference between the derecognized amount and the initial carrying amount, may be reported to profit or loss. Okay, and that is that. As I've explained earlier, your financial liability may be derecognized on the premise that it has been extinguished under either of these three conditions: when it is discharged, when it is cancelled, and when it expires. Now, another thing you could do is that even when you have no general understanding of the principle, you can follow this derecognition flowchart, and your answer to this question will tell you what to do. Now, for example, you ask, in part or in entirety, based on the assets, do you still have a right to receiving cash flow, or has it expired? If it has expired, it then means that yes, you recognize. If it has not expired, which you answer no, you ask yourself the second question. Those rights to cash flows, have they been transferred? If the answer is no, you also ask a question. Okay, is there any form of pass-through arrangement? If the answer is no, there's no derecognition. But if the answer is yes, you ask yourself, substantially, all of the risk and reward associated with the transfer, is it retained by you or it's retained by the other party? If it's retained by the other party, you derecognize. But if it's still retained by you, you now consider whether, the control itself is still retained. If the answer is yes, you continue to carry on the financial asset. But if the answer is no, you derecognize. These are just the basic principles to doing that. Now, finally, for reclassification, what does that mean? Reclassification means that, remember, for financial asset, we have three buckets: fair value to profit or loss, fair value to OCI, and amortized cost bucket. You may reclassify from any bucket to another, provided you meet these conditions. One, that the business model has changed, and it's solely as a result of the business model that has triggered the reclassification. Which means if the business model has not changed, but you just want to use accounting policy to change the class, or you just want to use your intention or your desire, such will not be permitted. Which means it's only when the modus operandi, the business model for holding that financial asset, has changed from what it was at its original recognition, that you can reclassify. And much often, you can reclassify from fair value to profit or loss to amortized cost, or from amortized cost to fair value profit or loss. But in a rare situation, you may reclassify from fair value to OCI, but in a very rare situation. But all of the situations must be supported by evidence that there's a change in the underlying business model. Okay, if not, you may not be able to reclassify. Okay, another condition where you may not be able to classify is if, by way of fair value to profit or loss, you have elected at initial recognition to designate such instrument, which naturally ought not to be at fair value to profit or loss, but you have chosen that. Such may be irreversible, and therefore, in that situation, you may not be able to reclassify, or because it was not the business model that made you classify it in the first place. Therefore, a change in that business model may not also affect it, or because you chose to do that. And that affects both fair value to profit or loss and that of OCI, because such elections are always considered irrevocable or irreversible, as the case may be. Now, the gain or loss from classification are usually recognized in profit or loss, okay, for financial asset measure at fair value, and that measure at amortized cost. Okay, and we must take that. And whatever the new value is will be the new carrying amount, either at fair value or at amortized cost, as the case may be. Okay, and that is that. And also, as I've said earlier, the classification is only permitted where there's a change in the business model. Now, changes in motive does not amount to changes in business model, okay? But we need to take it as a cognizance that changes in the business model is essential instrument or condition to more or less reclassify. And therefore, let me give you some practical illustration here. Let's look at the first scenario. An entity has a portfolio of commercial loans that it owes to sell in short term. The entity acquires a company that manages commercial loan and has a business model that owes the loan in order to collect contractual cash flow. And therefore, it means this more or less satisfies more of amortized cost. The portfolio of commercial loan is no longer for sale, and the portfolio is now managed together with the acquired commercial loans, and all are held to collect the contractual cash flow. Now, this is a practical evidence that there's a change in model, or because the acquisition of a company and the consolidation of those portfolio and alignment has created a change in business model. Another aspect is this: a financial service firm decides to shut down its retail mortgage business. That business no longer accepts new business, and the financial service firm is actively marketing the mortgage loan portfolio for sale. Therefore, it means that in this situation, they can no longer hold those things to maturity, which then means that the portfolio of amortized cost model is no longer visible. Therefore, this can more or less be carried out at fair value through other comprehensive income or through profit or loss, as the case may be. And therefore, this may be permitted. But there are other instances that are not permitted because they do not necessarily represent a change in business model. Example is where your intention changes, where your circumstances of the market condition changes. This is not changing business model. This is simply changes in circumstances within your reach or within the market. Also, where there's a temporary disappearance of an active market, where you may not be able to obtain a fair value at level 1 of the hierarchy under IFRS 13 fair value measurement, that does still not amount to changes in business policy model. And likewise, where you have to transfer financial assets between parties with different business model may not necessarily constitute that. Okay. Other considerations at this point is that you may not be able to reclassify financial liabilities, which means once you have a financial liability put at fair value to profit or loss, you may not be able to classify it to amortized cost or vice versa. And likewise, as I've explained earlier, the classification of equity instrument is not permitted. And that's why once you have taken that election, it seems to be irrevocable in that instance. Okay. And that is that in that manner. Okay, I think we've discussed derivative much more extensively in class, and I've also told you to watch them on videos. But again, what is critical about them is that all of derivative assets and liabilities buy via forward contracts, which we automatically call forwards, or buy via swap contract, which we call swaps, or future contracts, which we call futures, or option contract, which we call options, will always be measured at fair value, both at initial recognition and at subsequent recognition. And such changes, except otherwise, where hedge accounting is applied, they go to profit or loss. Okay, and also we'll discuss embedded derivative slightly in the video. And what it simply means is that you might have a derivative written that is not a standalone contract, but you have written such derivative alongside with a host contract, which means normal contract of sales, normal contract of inventory purchases, normal contract of construction, and the like. But you wrote derivative in order to hedge the risk inherent in such contract. The question then is, should we unbundle that contract as an hybrid instrument into the derivative and into the host contracts? And the essence of why you want to unbundle or thinking of unbundling is that you may have to account for the host contract separately in the way any of the relevant IFRS recognizes such transaction. For example, the construction contract, where you are the one that you are the contractor. Therefore, you apply IFRS 15, which is revenue from contract with customers. Okay, but the derivative aspect of it will be accounted for in line with IFRS 9, okay, at fair value. The question then is, for you to unbundle, naturally you need to see whether there are no relationship in existence, and two, whether the instrument may not necessarily qualify to more or less be treated together, much especially if the instruments are not derivative instrument, or where there is no economic relationship between the derivative instrument and the host contract, as the case may be. But IFRS 9 has probably simplified further more of the embedded derivative. What then simplifies is that most of the time, we don't need to unbundle embedded derivative, which means you have to treat both the derivative as embedded in the host contract as a whole, and you treat them in line with IFRS 9 much more at fair value. But only the time you have to unbundle that you may recognize the derivative strictly at fair value, while the host contract will be recognized in line with the applicable standard. Okay, if the transaction is like construction contract, you have to account for it under IFRS 15. If it's a lease contract, you apply it in line with IFRS 16. If it's an insurance contract, you apply it in line with IFRS 17. But if it's a debt security, equity security, or a repurchase contract, therefore you apply it much more in line with IFRS 9. And in such a situation, unbundling is not required because they have a close link, economic characteristics linked, and some other things like that. Okay, and that's why we said this is the simplification of I-39 rules and the difference from the treatment of financial liability host contract, as the case may be. Most especially for financial liability, you need not separate, as the case may be. You have to treat them as a single contract and measure them at fair value. Okay, I think at that point, we've dealt with extensively IFRS 9. Now let's wrap it up with IFRS 7, which borders on disclosures of financial instruments. Okay, what are we going to disclose? And thereafter, we can now look at fair value accounting to wrap up under IFRS 13. Okay, the objective of disclosure under IFRS 7 is to prescribe the manner in which you provide information that supports all what we've done with respect to financial asset, liability, and equity instruments in our financial statements, so that the users of financial reports can evaluate the significance of financial instruments, the nature and the extent of risk, and how such risks are being managed by the business, okay? And therefore, we are going to be looking at the disclosure both qualitatively, quantitatively, and as they affect the financial position, which is the balance sheet, with respect to asset, liability, and equity, and how they affect the performance, financial performance, which is the income and expense, and some other relative qualitative and quantitative disclosure, most especially with respect to risk management, financial risk management. Okay, and now this hierarchy or diagram more or less provides a simplified approach to it. There are three things we are looking at here under the three broad headings. The first one is the classes of financial instruments and the level of disclosure. Okay, what are the classes of financial instruments? You disclose your financial asset, liabilities, and equity instruments based on the class to which you have it. Okay. Two, those that you measure at fair value, you disclose the level of their fair value measurement. Okay, are they measured at level 1 of the hierarchy in line with IFRS 13? We'll get there, where you look at unadjusted quoted prices, or you look at level 2, where you have to more or less carry out some adjustments of quoted prices based on similar characteristics or nature. And the third one is where you look at unobservable data, with the observable data within the market to carry out some measurement towards having intrinsic value of a financial asset or financial liability. And this will be considered the last level, which is level 3. Okay, any of the level have to be disclosed because the highest level that have the highest, more or less, highest, how will I call it, that is much more regarded as a reflective of the fair value is the level 1, followed by level 2 and level 3 rank list, which then means that disclosure of those levels is very critical to people having better appreciation of what you carry as a financial instrument. Okay, the second aspect is the significance of financial instrument, and you're going to look at it from 3 subsections. One is the significance with respect to the financial position. Another one is the significance with respect to profit or loss and other comprehensive income. And the last is with respect to other form of disclosures, which borders primarily under accounting policies. You disclose your accounting policies for financial instruments. You also disclose if you do hedge accounting and the way and manner you account for the hedge. And thirdly, you disclose your fair value, which is a reiteration of the classes disclosure I've said earlier. Your fair value, what level of fair value have you used for each category of financial asset and liabilities? Okay, now for the financial position, what then do you disclose? You disclose the categories of financial assets and liabilities. You disclose much more those financial assets and liabilities that you measure at fair value to profit or loss. Any period you have done reclassification, you must tell us the objective of that reclassification, what assets have been classified, gain or losses arising from such reclassifications, and any other events that are more or less relevant. When in any financial year, you have more or less recognized any financial assets or liabilities, you must also disclose. For your financial assets, if they are collaterally backed, or for your liability, if you have to pledge collateral, you also have to disclose those collateral details, okay, in a manner that enhances the understanding and decision-making of the users of financial reports. Also, allowance for credit losses that we just finished, you disclose them in your financial statement. The methodology that has been used, and you attribute those financial expected credit losses to various methods you've used and to various financial instruments based on the stages they belong. Okay, and also where you have a compound financial instrument with multiple embedded derivatives, you disclose them and how you've accounted for them as a whole or unbundling. And if there are default or breaches on your financial asset or financial liability, you also disclose that for people to have better appreciation of the information contained therein. Now, with respect to profit or loss and other comprehensive income, every line item that constitutes gain or loss or income or changes in fair value from financial instruments must equally be disclosed. Interest expense or interest income you earn on financial assets and liabilities also have to be disclosed, okay? And also, much more importantly, impairment losses by classes of financial assets have to be disclosed, okay? Now, other things you disclose are based on the nature and extent of risk arising from financial instruments, and they are both qualitative and quantitative. Now, before qualitative, let me come to the quantitative. There are 3 critical financial risks that you have to deal with as a business. One is the credit risk, and credit risk is the risk of default, okay, where you might not be able to recover all of the value of your financial assets in terms of amount and also with respect to timing. Second one is liquidity risk. That is the risk associated with the fact that you might not be able to get the appropriate amount of cash flow you required when you have to liquidate your asset, okay, which means without experiencing material losses, which means if an asset is not liquid, it means you have to sell it at a discount in order to quickly realize money, which is an additional loss to you, okay? While market risk is more or less looking at the risk of changes in prices of financial assets or financial liabilities you hold, based on macroeconomic variables, market variables, such as changes in inflation rate, changes in FX rate, and some other things like that. Therefore, quantitatively, you disclose how you manage those risks and you quantify them with respect to, for credit risk, you quantify it through expected credit loss modeling. and also through sensitivity analysis on how that expected loss can vary based on changes in one variable to the other. Liquidity risk, you more or less disclose it much more with respect to your liquidity asset liability management or gap analysis. Okay, why market risk, you do much more of the analysis through sensitivity analysis and through value at risk, VAR model, depending on how you manage your risk internally. Now, quantitative disclosures are also disclosures around all of this, including disclosure about your capital management. Okay, in order to ensure that you still have sufficient capital to absorb unexpected shock or losses as a business that may arise from this financial instrument. Therefore, that more or less depicts all what we can discuss on the financial instrument disclosure. Okay, as I've said earlier, qualitative disclosures entails each type of risk, as I've explained, and entity must disclose the exposure to those risks and how they arise. They must disclose the objective, policies, and processes to managing those risks and the methods used to measure the risk. And if there are any changes between last year and this year on how the exposure to risk affect the business and other things, they must also disclose it. Quantitatively, you show summary statistics of the effect by way of sensitivity analysis, value at risk, scenario analysis, and the like. Okay, in that regard. Okay, that is that. Any question at this point before we go to the last discussion, which is IFRS 13, fair value measurement? Any question at this point? Any question? Okay. No question. Okay. Now let's move to fair value measurement. Now remember, when we started, I've always emphasized that, okay, let us assume that fair value is the market value. But forthwith, we will no longer assume that is market value. Why? Because market value, mostly unadjusted quoted prices or market value, are usually the highest level you can obtain in fair value measurements. Okay, and you can see this triangle that talks about fair value hierarchy. Okay, the highest level is level 1, which are the quoted prices. Level 2 are the second highest, which are the observable prices, or usually the adjustment of quoted prices of similar securities. And level 3 are more or less, let me use the word less transparent, but they are the lowest up or lowest ebb of fair value measurement, where you have to use probably sometimes a combination of market observable data with non-observable data or data that are idiosyncratic to the business, and you use various valuation methodologies to determine the fair value. Okay, but that's the lowest level you can ever accept at fair value measurement, which means if you have to give more weight, you give the highest weight to quoted prices, which is level 1, followed by level 2 and level 3. Okay, now when we say fair value can be considered from 4 perspectives, okay? Which means these 4 things are instrumental to obtaining what fair value is, which means none should be missing with respect to this. And what are they? 1, fair value talks about price. Okay, price is the worth of exchange, or what you consider the worth of something that is on ground. Now, what is that something we are looking at? We are looking at the price of assets or the price of a liability. In this case, let's say financial assets and financial liability. But again, fair value is not strictly limited to only financial assets and financial liability. It extends towards all assets. and all liabilities. Okay, now, but the price we are looking at for assets and liabilities are priced within transactions that have occurred. And what does that mean? It means they are transactions that are more or less done in a market overt, in an open market, and in an active market where we have active participants, both the buyers and the sellers. And we consider them active participants where it possesses two qualities. One, the first quality is that they are knowledgeable about what and what to be traded upon. And secondly, they are willing and they are not coerced, or they are not under unfavorable condition to sell or to buy. Which means that if this attribute takes place, we believe that such a market is an active market. And lastly, we need to obtain the price at a spot. What is the spot? The spot is the measurement date. Why? Because the timing matters, or because the price change along with time. We then speak to the fact that the price yesterday is different from the price today. Therefore, we must be very circumspect about at what point are we measuring? When is the measurement date? And the measurement date conventionally could either be the trade date, when two parties are committed to doing transaction, or the settlement date, when two of you are now expected to exchange your cash flows. Okay? And therefore, any of those two are acceptable to use for financial instrument, depending on your accounting policy. Okay? But most times, the price changes between the measurement date and the trade date are negligible. Okay? These features are so critical of the fair value. Therefore, the four features of the fair value are the price, the asset and liability, the transaction, and the measurement date. Okay, and that's why we consider fair value as the measurement date price received to sell an asset or paid to transfer a liability in an orderly transaction between market participants. Okay, and that's why you find out that IFRS 13 clearly defines fair value as the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. And that is critical of note for us in this case. Now, I've explained all of this, what the price is, what the asset or liability is, what transaction is, and who are the market participants, and what quality do they bring to the table, must they have at that point in time. Okay, the next one is the way we carry out fair value application on non-financial assets differs from financial assets. What are non-financial assets? These are any form of asset that is not financial assets. Now, what means, since we know what financial asset is, any other thing that does not constitute financial asset is non-financial asset. And what are they? If you have item of PPE, you have item of investment property, you have item of inventory. Okay, and again, inventory here is not inventory of financial asset, but inventory of any other commodity, which you call stock. Okay, where you have intangible assets. All of these are non-financial assets. Okay, and in that case, the methodology under fair value we use under IFRS 13 is all called the HBU, highest and best use, which means you consider that, okay, if I can use this asset for production, or I can use it for trading, or I can sell it outrightly, which of it produces the best usage of that asset? Which means which one produces the optimal value or the maximized value from that asset? And that will be used to determine the fair value. Okay, and that's why we say here that fair value measurement of non-financial asset consider the market participant ability, not the entity, to either generate economic benefit by using the asset in its highest and best use, or sell the asset to another market participant who will then use the asset in the best use. And there are three factors you consider to determine whether you might use it in the best use. One is the physical possibility of where you can use the assets. Okay. Second one is the legal restriction or permit you have to using the assets. And the third is the financial viability, which I mean that these three conditions are preconditions to determine objectively when and how is the highest and best use of an asset. Okay, for example, let's look at valuation premise that may be a standalone premise. If the highest and best use is on a standalone basis, what then do you do? The fair value in that case will be the price that we receive in the current sale to a market participant that will use the asset on a standalone basis. Whereas if the asset have to be used in conjunction with other assets or other activities in order to produce value, in that case, the fair value will be the price that will be received in a current sale to market participant, assuming the asset will be used in combination with other assets, and which are to assume to be available to the market participant. Now, the general principle in all of this is to ensure that for items of PPE, investment property, inventory, and intangible assets, 8B will be the way to determine the fair value. Okay? Also, we have general principle for liabilities and equities, which are also the same. And most times, equities are based on intrinsic valuation, which are unobservable at the time you want to issue equity, except when you are not buying equity at the current market price, which is existing equity that already exists. But new equity are based on company valuation, and which are always based on future expectation, financial assumptions, variables, and the like. Okay, but let's focus on the normal financial assets. Okay, and as you have said earlier, all financial instruments and financial assets have to be recognized at initial fair value, okay? And subsequent recognition is subject to the class they belong to. But again, as I've said earlier, we have three levels of hierarchy. Level one are observable quoted prices in an active market, okay? And level two are quoted prices and may not be available, but the fair value are based on observable market value, market data, which might be adjusted market prices of similar securities. And this happens where you are more or less valuing unquoted stock, or you are valuing stocks that is quoted, but of which active market has disappeared on such financial assets. Now, the last one is unobservable input for assets and liabilities, where you have to more or less use some internal mechanism to obtain unobservable data and use it to carry out valuation. And in that regard, we have about three methodologies to doing that. Okay. We have about three methodologies to doing that. Okay. But again, if you want to go further to have better granular understanding of how is market-based measurement arrived at, you can follow this flow chart from the IFRS Foundation. Okay. You ask yourself a simple question. Is there a quoted price in an active market for an identifiable asset, identical asset or liability? If the answer is yes, you use this quoted price to measure the fair value, which is level one. Must use without adjustment, that's level one. But if the answer has been no, you replicate a market price through evaluation techniques using observable plus unobservable input, which is a combination of level 2 and level 3. Now, where no significant unobservable input, level 3 input, therefore, that means you do it by level 1 measurement. But when you use more of significant unobservable inputs, therefore, that is level 3 measurement, as I've explained earlier. Now, this is a decision tree that might equally follow for liability measurement at fair value, okay, which I've explained under financial liability at the other time. But again, the valuation techniques you use much more often is based on either the market approach, where you used comparable market prices, okay, using market metrics such as PE ratio, such as EBITDA ratio, and some other things to carry out valuation. You also use income approach. Income approach is much more of the discounted cash flow techniques, where you estimate future cash flows and discount them to the present based on the cost of capital relevant to estimate the value. And another one you can use is adjusted net asset value, which means you pick a company, for example, or you pick an asset, for example, and you look at it, okay, in the individual components that make up the item, can you more or less check what is the replacement cost for each one, which is already reflecting a current cost of those assets and liabilities. And at the end of the day, your net position becomes the new adjusted net asset value. And you can use that. And in the barest minimum, cost can be a surrogate in the barest minimum, and it's very unlikely to have that situation. Okay, and also the unit of account is also a determining factor on measurement. Okay, but again, that is not much of what we want to discuss now, but rather the valuation technique. Okay, and again, this is just to show you again, if it's level 1, under market approach, what do you use? Price of identical item, and must be used without adjustments. If you are to use income approach, directly identify cash flows, but cost approach, you may not be able to use at this level 1. Level 2, price needs adjustment, observable input. Okay, while level 3, price needs adjustment plus unobservable input, as the case may be. Now, again, to summarize it, the market approach, you have the transaction price of identical transaction, comparable companies valuation multiples, which I've mentioned, PE ratio, EBITDA ratio, net assets ratio, and some other things. Income approach, you use the discounted cash flow methodology. You can use the Gordon growth rate model. You can use the H model. Every of that is what we consider as a dividend discount model. You can use constant growth rate. You can use market capitalization when you are using things like supernatural profit. Okay, and finally, a combination of approaches may be used to determine the adjusted net asset method. Okay, and what you have to disclose are what we have here. You disclose them based on the hierarchy levels and how such are determined and what methodologies were used, as the case may be. Okay, that is that. But let me see if we could look at a question on that. Okay, question 10 says, describe briefly the types of hedge in line with the requirement of IFRS 9 that your company can be exposed to, and explain the account implication, given that your company voluntarily applies the principle and requirement of hedge accounting. Yeah, okay. And this has been explained, and I've given you this as an assignment, but let me do something and see whether my GPT, my own GPT, which is Economics GPT, will answer that. Okay, I believe you guys can see this. Okay, let me just let me allow it to translate and see whether I could call it right. This is my GPT I developed in Economics GPT, and let me see whether it will answer the question correctly. Briefly described it, okay? Let me give it that just a constant answer. So that doesn't give me. I hope you can see the GPT. What happened to my network? What happened? Okay, pending that time, you can see what I put on the screen. Okay, to determine the net adjusted net approach, it's one of the methodology used. Now, if a company is to be valued, the company's net asset position that's what you see on the screen. This is the kind amount based on historical cost. Subject to financial adjustment. Now, we'll determine the PPE. Now, PPE, what we can use to say the PU, and the placement cost we found out is 2.3. Now, investments, probably we use level 1, which is market value. Receivable, probably we use level 2 or level 3. Payable, that's what we use level 3. Lease obligation, level 2. Why other things, we inventory, intangible, we use the highest and best use. Why this has no changes? Because they have no equivalent of fair value. They are always the same. Okay. Now, at the end of the day, we're able to have the fair value. And now the fair value is 4.8 net, while the buying amount was 3.8. Now, if the number of shares is 1 million units, therefore, the estimated fair value based on adjusted net asset is 4.85 kobo. This is one of the ways to which we'll determine that. Okay, now let me go back to my GPT. I think there's something wrong with the network or connecting stuff earlier. Now let me run it and see what happens. Okay, I didn't put it to change concisely, but it will repeat it, whatever I want to do. Now we're searching the knowledge based on the algorithm I built inside, and it's going to produce an answer. But I'll try and mark the answer, whether if it has been my student, you will have scored a good mark. Now you can see what he gave me. And I think he answered it very well. Yeah, you answered it very well. Now let me copy the question and send it to your chat. Let me now copy the answer. Let's also check whether it's going to solve some of the questions we've solved now correctly. My network, what's wrong with it? One sheet network. Can you guys hear me? Just send me a chat if you can hear me. Okay, I think you guys can hear me. Okay, let me now, one of those questions we solved earlier. Let me go to my Excel sheet. Okay, I've sent the question. I've uploaded. Acting effective interest. Let's see. Okay, so something okay. As we reload, I think my network is poor somewhere. Towards the end, my network is probably messing up. Okay. Network is very low now. 712. It gave me the same thing we got, 3.1936. And he explained, okay, I can say it provides the narrative and simple step-by-step solution. The network is really seriously. Okay, you can see the explanation. Now you can compare that with what we did in class and what we also did today on Excel. We got the same thing. Okay. Okay, let me ask you to complete the other question. Okay, to answer the questions B and C. At every point in time, the network is failing. Now you have generated the schedule. This is the schedule if you want to see it. You've seen the schedule. You have generated the schedule. I can download it. If I open it on Excel, you can see the Excel. That's what you're seeing. Okay, the same thing as what we've done. Which means you can make my economics PPT your teacher if I'm not there. Okay, and he has also given me this. If you want this explanation, we broke it down. He has also given me the accounting entries, what to debit, what to credit for each of the periods. The same way we've done it in class. Therefore, I prefer this response, and that is all for you. Okay, let me also find a final question. Let me give you the question we had here earlier on the simplified approach. That's question 9. Captain questions and provide short step-by-step narratives. Okay, the step-by-step narrative, he has calculated it 275 days for the first one, and he was able to classify them based on the band. And you could see that I got 114, and we compare it with 124, and you got 9,600, which is gain. Can you see it? Therefore, you can use it as your teacher. Okay, he has used my Python code, IDE, Integrated Development Environment, to solve it, which is the engine he has used. The same thing I did for you in class, he has been able to do that with Python, and that is it. Okay, let me also see whether you can attempt to solve, which means if I mark it, it's going to be scoring very high compared to what you guys will score. Let me also look at the question of impairment on that window and see whether it's going to score high. Currently, I scored 100% in everything. Network. Okay, you got it right. 80, 60, there's somewhere in missed. Okay, he missed here. He computed the coupon on the, this is not the face value. This is the redemption value. That's where he missed it. Otherwise, the solution would have been the same. He missed it. Let me tell you that you missed it. You slightly missed it as you unintendedly used the redemption value of 1,305,350 as the face value, whereas the face value was 1 million naira. And correct appropriately. Here we have created that 50,000. See? Yes, 30, 800. No, you have see, he has filled this also. He used the final principal is not this. The final principal included a premium of 305,350, which made the final redemption value to be 1,305,350. That's correct. Your picture. Yeah, he's picking it up now. Okay, let me see what happens. There's a scratch to this level. Yeah, you got it right now. Yeah. Guys, how do you find this? Is it interesting? Is it interesting? Let me unmute you guys if you want to talk. I've given all of you access to unmute. Is it interesting? What is it? Does it interest you? Hello, I can't hear you. Kalu, you're about saying something. Okay, you guys can still unmute. Okay, I've granted it now.
Yes, it was. It was.
Okay. Who
Yeah.
else? Oluwatobiloba, you're about saying something?
Yeah, I wanted to say it's very interesting how you were able to correct ChatGPT. It's very, very interesting.
Yeah. Okay, but this is not GPT. This one is my own GPT, Fibonacci GPT. But the same thing ChatGPT will have done, and I can correct. And once it's
Okay.
in its mistake, it's going to update its knowledge. You understand?
Okay.
Yeah. Okay.
Thank you.
Any other question before we wrap it up? Okay, let me put questions on fair value for equity we did in the last time in class. There's this question we did. Let me copy and paste it directly. Okay. Let me see whether it will answer it. What's wrong with the network? I suspect the network is due to connection with the data center. It seems it's angry. Okay, you can try it on your own. My network seems to be very poor now. Okay, let me now discuss the final stuff we want to discuss here. The issue of most advantageous market and let me see whether I make reference to it in the slide. The primary market and most advantageous market. Okay, if I don't make mention to it, I can explain it to you. Okay, let me explain it to you with the Excel. Let me explain it to you with the example. Fair value. Now, primarily, financial instruments have a market, which we call an active market. That's its primary market. But sometimes a financial instrument may be traded in more than one market, in which you can't say one is more active than the other. Which means where a financial instrument have more than one active market, where we can predetermine its primary market, therefore the next thing for us to do is to determine its most advantageous market. And what is its most advantageous market? Its most advantageous market is a market where we have the highest amount we can consider the fair value after considering both the transportation cost and transaction cost. And you already know what transaction cost is, but what you are hearing for the first time is transportation cost. A transportation cost is a cost that you have to incur in bringing a particular asset to the market. Now, in this case, it's not like you are going to go and get motor vehicle to carry it. No. What we are simply saying is this. A stock might be trading in 3 markets. And if you are to sell in a particular market, you have to move your stock in one market to another, and there's a cost of movement. And let me explain. For people that trade Bitcoin, understand that sometimes your platform in which you trade Bitcoin differs. And you can move from one platform to another, but it comes at a cost. Such cost in moving your Bitcoin from platform A, whether Binance, to platform B, Luno, will come at a cost to transport. Such is what we call transportation cost. It's quite different from transaction cost. Transaction cost is the cost you incur in order to execute transaction in a market. Okay, which that means that in this case, fair value in the most advantageous is determined with reference to these 3 variables. 1, the fair value itself. 2, the transportation cost. And 3, transaction cost. Now, which that means that if you have, let me say we have NGX, which is Nigerian Stock Exchange, and we have FMDQ Exchange. These are the 2 markets in Nigeria. And let's say both market trade bonds, federal government bonds. Therefore, we want to determine the most advantageous market. Therefore, we look at it, bond details. What is the fair value? Or let me see, what's the market price in each market? Now, what is the transportation cost? And what is the transaction cost? If the fair price is 100, transportation cost, let me say, is 2. Transaction cost, let me say, is what? 3. And this is 101, but transportation cost is 3. And this one is, okay, let me say this one is 4. Therefore, To determine it, we'll look at what is the value here, 95 as against 94. Okay. Now what we are saying is this. What we are saying is this. Now, which one is the most advantageous market? Which between NGX and FMBQ is the most advantageous market for this bond? The answer will be what? The answer will be which one provides the highest value. And the most advantageous market is NGX. It was NGX. Now, why is it NGX? Because NGX produces the maximum between 95 and what? 94. Even though when you look at it here, FMDK has market price as is 101. But by the time we take away transportation cost and transaction cost, it's not giving 94, whereas NGX is giving 95. And therefore, we'll take NGX as the most advantageous market, given this amount. The next question then is, what then is the fair value to be adopted? The fair value will now be equal to the market price less transportation cost, not transaction cost. And somebody will win price. I mean, why would we not consider transaction cost in determining the ultimate fair value? Why are we not going to consider transaction cost in determining the ultimate fair value? First person to get it right will win something. Now, in this case, the fair value will now be, if we have NGX as our market, it will now be this and this, which is what? 98. 98 is our fair value. Who wants to answer that? Who wants to answer that? Nobody's raising up hand. Fair value, the most advantageous market. I can't see any answer up. Not clear. You guys are disappointing me. Nobody wants to try. Okay. But where you already have a primary market, you don't carry out this analysis. It's only when you can't say this is the primary market because they are too close to call, and you have to now determine the most advantageous markets. Okay, that's that. Now, the reason why we don't consider transaction costs is that independently, transaction costs will be treated in line with the classification of financial assets and financial liability. Therefore, if you have considered it in the fair value year, it will be double counting, because when you still get to your accounting, where you have to expense transaction costs, you expense. Where you have to add or deduct, you deduct. Therefore, when you have already deducted here, therefore you are double counting. That's why here you only consider these two. You only consider these two. You only consider these two invariably. And also, you consider that NGX is the most advantageous market. Okay, that is that. Any other question? Otherwise, we'll call it a day. Thank you very much, guys.
Hello, sir. Sorry, sir.
Yeah.
I got disconnected when you asked the question that why do we not consider the transaction cost in determining our fair value? So please,
Yes.
can you recap on the answer?
Yeah, I said we don't consider it because transaction cost already is considered in the accounting treatment. Now, let me go back to the slide. Because treatment of transaction cost is done separately based on the classification of the financial instrument. Okay, it's not on this particular slide. Okay, let me go back to your notes. The one I did for you in class. Okay. Just give me a second. I think I'm close to it. Yes, I've seen it. Can you see it on the screen?
Yes, sir.
Okay. What do we say about transaction cost here?
Okay, initial recognition, we treat it as an expense.
Now, if we have already deducted this transaction cost from what we just did, will you be able to separate this into profit or loss? No. The fair value you see here now is the market price less transportation what cost. That's the fair value you see here. Because transaction cost will be treated separately, depending on the nature of the what financial asset and the class. Therefore, you will not consider transaction cost in determining fair value. You only use transaction cost in determining the most advantageous market in which you want to pick your fair value from. Does that make sense? Does that make sense? Can you hear you? Okay, I think it's off again, network. Okay, any other question? Any other remark? Any other discussion? If I call it a day. And thank you for you guys. Okay.
Thank you, sir. Thank you.
Yes, I will. Give me 1 minute. Sorry, you guys, give me 1 minute. Sorry, all of you have your full names except for, okay. All of you have your full name except for Itunola. What's your full name? Okay, she's not responding. Okay, who is also Victory? What do you say?
Dada is no.
Dada, Abi?
Yes, sir. It's no.
Okay, what about Victory? Victory. What is Victory? Those are the two people. Victory.
Hello, sir.
Yes, who is Victory?
Yes, I'm the one, sir.
What's your full name?
Victory Obadi.
Okay. Okay. Okay, you guys will see me tomorrow for your prices for your 7 people here that I've identified. Okay. You'll see me tomorrow for your prices. Okay. Because you are the 7 that stood to the end, even though you may not have started. Kalu, you have already won something before. Therefore, it's the same thing I want to give to you that I'm giving them. Therefore, it means 6 additional plus Kalu, making 7.
Okay, sir.
Now, all of you get a copy of my text tomorrow on contemporaneous accounting for business combination. Is that okay?
Right. Yeah, thank you.
Yeah.
Thank you, sir.
I've
Thank you,
grabbed
sir.
the name. Yeah, I've grabbed the name. Thank you.
Thank you, sir.
Guys, take care. Bye. I'll share all the materials to you guys. Bye-bye.
Bye,
Bye-bye,
sir.
sir. Thank you, sir.